I want to start today by talking about a specific piece of mail. It usually shows up once a year, right? It's in one of those, generic window envelopes,
The one you don't want to open.
the one you absolutely do not want to open. And depending on where you live or, what the market is doing, opening it either ruins your morning or it ruins your entire month. It's the property tax bill.
The dreaded annual reckoning.
Right. But here's the thing that I noticed while I was going through all this source material for this deep dive. We spend virtually all of our energy, all of our outrage, complaining about the tax.
The rate.
The actual check we have to write.
Yeah.
We argue about the tax rate. We argue about the mayor's budget. We argue about whether the trash is getting picked up on time for what we're paying.
It's all the downstream effects.
Exactly. But we almost never, and I mean never, stop to look at the number that actually dictates the size of that check in the first place. We ignore the value that's assigned to the house itself.
Which is, it's a fundamental mistake.
Mm-hmm.
Because you're right, the tax rate is just a multiplier. It's a variable. It can change year to year. The assessment, that specific dollar value assigned to your property, that's the bedrock.
That's the foundation.
It is the raw data upon which the entire state apparatus is built. If that number is wrong, everything that follows it is wrong too.
But I think the reason we ignore it, or the reason I've ignored it, is because we assume it's just reality, If I asked you what my house is worth, I'd probably go look on Zillow, or I'd look at what my neighbor's house just sold for.
Right, you look for market signals.
Yeah, and I just assume the government kind of scrapes that same data, runs a program, and sends me a bill. I really didn't realize there was this massive, bureaucratic machinery specifically designed just to generate that one number.
If only it were that simple and that efficient. No, that right there is the core misconception we have to get past. Market value is what a willing buyer is willing to pay you on a given Tuesday. That's it. Assessed value is. It's an administrative opinion. That's the best way to think about it. It is a judgment call that is made by a human being, or increasingly an algorithm,
Right.
that has to adhere to very specific and often very archaic laws.
A judgment
It's
call.
not just a simple question of what is this worth. It is what is this worth for the specific purpose of keeping the local government funded and running.
Yeah.
And those can be two very different numbers.
Administrative opinion is a very, very polite way of saying a guess.
An educated guess, you would hope, ideally. But yes, at the end of the day, it's an estimate. And that really is our mission for this deep dive today. We're not here to debate tax policy, whether taxes should be high or low. That's a different show.
Right.
We're going to unpack the black box of valuation. We're going to try and figure out who these people are with the clipboards, why the math is so intentionally confusing, and, it is full of some wild jargon.
Well, we're going to get to that.
And how this same mechanism of, like you said, guessing value applies not just to your front porch, but to everything up to and including global corporate profit shifting.
And it really does feel like a black box. The source material you pulled for this is this. It's a massive overview of tax assessment. It covers everything from the tiniest details of U.S. local laws to, these global tax havens. And what struck me is that the word assessment itself, it sounds like the most boring word in the English language.
It sounds like homework. It really does.
It does. It sounds like something you have to do, not something that's done to you. But what I'm realizing is that it's actually this incredibly high-stakes game. It is the moment the government looks at your little slice of the world and puts a price tag on it.
That's it. And that one decision dictates the flow of so much money in our society.
So it's the bridge.
Precisely. Without an assessment, the entire system is paralyzed. You can have a tax rate, you can have a government that's desperate for cash, but until someone, somewhere, assigns a specific number to a piece of property or a car or a transaction, you cannot generate revenue. It's the trigger. It starts the whole chain reaction.
Okay, so let's start there. Let's start with the hook, the human element. We all know we have to pay. It's one of the guarantees in life. But who actually decides how much my slice of the world is worth? Because in my head, it's just the government. This faceless entity.
It's rarely faceless when you dig in.
Yeah.
In the U.S. context, it is usually a very specific person. They're called the assessor, or more formally, the tax assessor.
Okay, but the sources we looked at, they highlight that this isn't just some civil servant in a back office stamping forms. This is a weirdly powerful role.
It is an incredibly powerful and, frankly, undervalued role in the public eye. This one official is charged with determining the value of each and every taxable property in their jurisdiction.
Each one.
Every single one. So think about the scope of that. In a major city, that could be hundreds of thousands of individual parcels. In a rural county, it might be thousands of acres of diverse land, farmland, forests, residential lots. And this one office has to put a number on all of it and say, this is worth X, and that over there is worth Y.
And here's the part when I read this in the notes that I found genuinely baffling. I had to read it twice. In the United States, this person is often elected.
Yes. In many, many jurisdictions, they are an elected official.
That seems absolutely insane to me. You are literally voting for the person whose only job, their entire reason for existing, is to calculate how much money you owe the government.
It creates a fascinating political dynamic, doesn't it?
It creates a massive conflict of interest. I mean, can you imagine running a campaign on the slogan, "Vote for me, I promise to accurately value your home at the current, totally inflated market price, which will thereby double your taxes"?
You'd lose in a landslide. No one would ever vote for you.
Of course not.
Exactly. So what you end up with is this inherent tension. On one hand, the assessor has a statutory duty, a legal requirement, to be accurate and fair, to follow the market wherever it goes.
They have to tell the truth, basically.
They have to tell the truth about value.
Yeah.
But on the other hand, they are often politically accountable to the very voters who, understandably want their assessments and therefore their taxes to stay as low as possible.
Oh, they're stuck.
It puts the assessor in this position where they either have to be the bearer of bad news every few years, or they risk underfunding the schools and the fire departments and everything else. It is a genuine tightrope walk.
And to make it even more confusing for the average person, they don't even use the same titles everywhere. I got really stuck on this one term in the notes, you flagged it, regarding Vermont, this role called a lister.
The lister,
Yeah.
yes. It's a great, great term.
It sounds like someone who's in charge of organizing a grocery run for the town. Oh, don't worry, Bob's the town lister. He'll get the milk.
It does. It has that kind of folksy small-town feel.
Yeah.
And it is pretty unique to Vermont and, some other parts of New England.
So is it just a quirky name for an assessor? Or is the job itself actually different?
Well, today, the job is effectively the same. Their function is to determine property value for tax purposes.
Yeah.
But the etymology of the word, the history of it, is actually really important and tells you a lot about how this all started.
Okay.
It goes back to the concept of the grand list.
The grand list, what's that?
In the colonial era, and you can trace this all the way back to England, you had to literally list your property. You would go to the town official and declare on a list the number of cows you owned, the acres of arable land, the number of silver spoons, the number of clocks in your house.
Wait. So it wasn't just like, my farm as a whole is worth 500 pounds. It was a line-by-line itemized inventory of your wealth.
Yes, exactly. A detailed inventory. And the lister was the person responsible for compiling that inventory from everyone in town. They were the ones checking your list against reality, making sure you didn't, forget to mention a few cows.
Wow.
So modern assessment is usually what we call ad valorem, which is just Latin for according to value. It's based on the total value of the property as a single unit. But that lister title is this amazing holdover from a time when the tax was based on the specific things themselves.
It feels incredibly invasive when you put it that way. Someone from the government coming around to literally count your spoons.
It was. And, in many ways, the modern version still feels that way to a lot of people. When a property appraiser in Florida, that's the title they use there, or an assessor in Ohio knocks on your door, they might not be counting your spoons, but they're absolutely checking to see if you finished that basement you took out a permit for.
Right. They're looking for improvements.
They're looking to see if you added a deck or a pool. They are, in effect, updating the inventory of the jurisdiction to ensure that everyone is paying their fair share based on the current state of their property.
So it doesn't matter if you call them a lister in Vermont, a property appraiser in Florida, or just a tax assessor everywhere else, the function is basically the same. They are the ones who provide the data.
They are the gatekeepers of the math. They provide that base number. And this actually brings us to the core definition of the term itself. The source material makes a really important distinction between assessment as an action and assessment as, the bill you get.
Right, because I've definitely heard people say, oh, I got my assessment in the mail, and they mean the bill, the tax liability.
Colloquially, yes. That's very common. It often refers to the specific amount of money you owe, the debt.
Mm-hmm.
But for our purposes, strictly speaking, and for this deep dive, assessment is the act of valuation. It is the process of determining the value and sometimes the use of a piece of property.
You said use of property. Why does the use matter? Isn't a 1-acre lot a 1-acre lot?
Oh, the usage changes the value dramatically.
Mm.
Think about it. Is that 1-acre plot of land a working farm that's zoned for agriculture?
Okay.
Or is it a commercially zoned lot in the middle of a city that's about to become a shopping center? The dirt might be the same, but the tax implications are wildly different. The assessor has to make that determination, that classification too.
So it's not just about running a calculator, it's also a judgment on what the land is, what its purpose is.
Correct.
Yeah.
And while we're focusing a lot on real estate, because, that's the most common touch point for most people, the source notes this applies to personal property too.
What do you mean by that?
Well, in many states, businesses have to pay an annual tax on their tangible assets. Their computers, their desks, their machinery, all of that has to be assessed.
Mm-hmm.
In some places, you pay an annual property tax on your car based on its current value. That requires an assessment every single year.
It's everywhere. Okay, I want to pause on the math here because I think this is where most people's eyes just glaze over. And I have a suspicion that that's at least partly by design. The source material mentions the mill rate.
The mill rate. It is the source of more public confusion than almost anything else in local government finance. It sounds complicated, but it's actually not once you understand why it exists.
Well, that's my question. Most taxes I pay are just straightforward percentages. Sales tax is 7%. My income tax is, roughly 20 or 30%. Why on earth does property tax use mills? Why can't they just say the property tax is 2%?
It comes down to how the budget is constructed. It's a completely different philosophy, like we said earlier. Think of it this way. Sales tax is passive. The state sets the rate at, say, 7%, and then however much stuff you buy, that's how much revenue they get. If the economy crashes and you stop buying things, the state gets less money.
Okay, so their revenue just floats with the economy. It goes up and down.
Right. But property tax, especially for a town or a city, it works completely backward. A town government generally doesn't start the year by saying, what rate should we charge?
They don't. What do they start with?
They start by saying, how much money do we need exactly to keep the lights on?
Oh, so they start with the final bill.
They start with the budget.
Yeah.
Let's say a town needs exactly $1 million this year. That $1 million pays the teachers, it pays the roads, it runs the police station. It's a fixed cost.
Okay, $1 million.
The assessor then looks at the whole town and says, okay, the total value of all the houses, all the businesses, all the taxable property in this town adds up to $100 million. They now have a problem to solve. They have to find a rate that extracts exactly $1 million from that $100 million base.
Which would be 1%.
Mathematically, yes, it's 1%. But in the world of municipal finance, they express that using the Latin word millissimum, which just means thousandth. So a mill is $1 of tax for every $1,000 of assessed value.
Okay, so 1% is $10 for every 1,000. So it's 10 mils.
Exactly, 10 mils.
It still feels like an extra layer of unnecessary jargon just to obscure the true cost from people.
I think there's some truth to that, whether it's intentional or not. It also creates a buffer. It allows for tiny fractional adjustments, like going from 10.1 mils to 10.2 mils, that can add up to a lot of money across a whole city without looking like a massive percentage hike on paper.
A psychological trick.
It can be. But here is the real catch, and the source highlights this as a major warning. You cannot understand your tax bill by looking at the mill rate alone. You have to look at something called the assessment ratio.
This was the part that made me feel like I was actively being tricked. The assessment ratio.
It is the hidden variable in the whole equation.
Okay, so break this down. In a normal, rational world, if my house has a market value of, say, $500,000, the assessed value on my tax bill should be $500,000.
Right. That is what's called 100% valuation. And some jurisdictions do that. It's transparent. It's easy to understand. What you see is what you get.
But the source says many other areas use a ratio. Explain how that works.
So another jurisdiction might have a policy written into law that the assessed value is only, say, 50% of the market value.
So if my house is really worth $500,000, the town just pretends it's only worth $250,000 for tax purposes.
Yes, that's exactly what they do.
Why? I mean, that sounds nice. It sounds like I'm getting a deal.
It feels nice, and that's the point. It is almost entirely psychological. You open that assessment notice,
Yeah.
You see a value that's way lower than what you paid for the house, and your first thought is, phew, the tax man did catch me, I'm winning. You feel relief.
But I'm not actually winning, am I?
Not at all. Because remember, the town still needs that $1 million budget. that number is fixed.
Yeah.
If they artificially cut everyone's assessment in half across the board, what do they have to do to the mill rate to get the same amount of money?
They have to double it.
They have to double it. It's a shell game. The final check you write is often exactly the same.
That is so devious, it's psychological taxation.
It works. It keeps the taxpayer passive. Because if you feel like you've already won on the valuation side of things, you're much less likely to go through the hassle of appealing it.
Wow. Okay, but let's talk about that. What if the assessor is actually wrong? Not just using a ratio, but legitimately wrong about the physical house. Like, they have on their records that I have a finished basement, but it's actually just a dirt pit full of spiders.
Then you have a problem with the core data. And this leads to the taxpayer's only real recourse, the appeal.
And the source material really emphasizes that this is a legal right. This isn't just, complaining.
It absolutely is.
Yeah.
Because an assessment is legally defined as an estimate, the statutes in most places acknowledge that it can be flawed. But, and this is a very, very big but, you cannot just walk into the assessor's office and complain that your taxes are too high.
I can't afford this is not a valid basis for an appeal.
It is not. That is a grievance you might have with the budget committee or the city council who sets the spending. An appeal is strictly and only about the value. You have to prove that the assessor's number is wrong.
So how does a regular person even begin to do that? I mean, they're the expert with the clipboard. I'm just a homeowner.
You have to become an expert on your own house. You have to generate your own data. The source notes that the very first step for any taxpayer is to make their own independent estimate of the market value.
So I have to do their job for them.
In a way, yes. You need to find comparable houses in your neighborhood that have sold recently. You need to take photos of your dirt pit basement. You need to get repair estimates if your roof is failing. You are effectively building a legal case to say, you, the town, think this house is worth X, but here's my evidence that the market says it is actually worth Y.
It sounds like an enormous amount of work for the average person.
It is. And the system is designed that way, to a degree. The burden of proof is almost always on the taxpayer. The assessor's value is presumed to be correct until you, the homeowner, can prove otherwise with overwhelming evidence.
Of course it is. And the source mentioned that this becomes really, really critical during these periods called revaluations.
Revaluation is the moment of truth, or the moment of pain, depending on your perspective. See, most towns, it's just too expensive and time-consuming to update every single house every single year.
So they just leave the values the same for a while.
Exactly. They might go 5, 7, even 10 years without systematically changing the values on the books.
So your official assessment stays flat while the real estate market is going completely crazy.
Precisely. You might be sitting there with an assessment that's based on 2015 prices, while in the real world, your house value has doubled since then. You've been getting a deal, in a sense. Then the town announces a revaluation. They hire a firm. They update every single property to current market prices.
And suddenly your assessment doubles overnight.
It can, yes. And your tax bill, even if the mill rate goes down a bit to compensate, could still skyrocket. That revaluation period is the window where you have to pay the most attention.
Okay.
That's when the most errors happen because they're doing it in bulk, and that's when you really need to check their math.
I feel like most people just get that letter, see the huge new number, get angry for a day, and then just toss it in a drawer and hope it goes away.
I think you're right.
But what you're saying is that that letter is really an opening bid in a negotiation.
That is a very healthy and accurate way to look at it.
Mm.
It is a proposed value. You have the legal right to counter-propose as long as you play by the rules and bring the evidence.
Okay, so we've covered the house, we've covered the local stuff, the listers and the mill rates and the appeals, but the source material for this deep dive, it goes way, way broader than that. It has this incredible taxonomy, this categorization of taxation, and it turns out you can assess pretty much anything on the planet.
It really is a broad field. We've been talking almost exclusively about ad valorem taxes. Again, that's just taxes based on value, like property tax. But the source lists so many others, and they really reveal what a society prioritizes and, what it wants to discourage.
Let's run through a few of these because they paint such a fascinating picture of the world. First up, the obvious ones. The sin taxes.
The classic example. These are excise taxes, usually on things like alcohol, tobacco, sugary drinks, gambling.
And the assessment here isn't normally based on, the value of that specific bottle of whiskey, right? It's not ad valorem.
Right. It's often what's called a specific or unit tax. It's assessed based on the volume, per liter of alcohol.
Yeah.
Or it's a flat rate per pack of cigarettes. But the intent behind the tax is totally different.
How so?
With property tax, the primary goal is just revenue. We need money to run the town. With the sin tax, the goal is partly revenue, but it's largely about social engineering. We are consciously assessing a cost to your bad behavior in the hopes that it will discourage you from doing it.
We're trying to make it too expensive to smoke.
Essentially, yes.
Yeah.
Then you have the environmental taxes.
Yeah.
This source lists things like carbon taxes, landfill taxes, and this interesting one called severance taxes. The severance tax is a really interesting concept. And no, it has nothing to do with firing someone.
Yeah.
It refers to the act of severing a natural resource from the earth.
Oh, like mining coal or drilling for oil.
Exactly. The state or the nation is effectively saying this natural wealth, the oil in the ground, the timber in the forest, it belongs collectively to the land, to the people. If you're going to take it away, if you're going to sever it, we're going to assess a value on that removal and tax you for it.
Wow. That's a really philosophical way to view a tax. You're taking something irreplaceable from the planet, so we assess a cost to that action.
It's a way of monetizing the depletion of a finite natural resource. And then, of course, you have the huge category of consumption taxes. Sales tax, value-added tax, or VAT, which is common in Europe, hotel taxes, tourist taxes.
It's just relentless. It feels like everywhere money moves or value is created, someone is standing there with a clipboard ready to assess a slice of it.
That is the fundamental nature of the modern state.
Mm-hmm.
But what I found so fascinating is that the source also points out that this isn't modern at all. The deepest roots of assessment go back to religious duty and basic community survival.
Yes, I saw this, the religious assessments. The source listed things like the church tax, the tithe, the temple tax.
And then these very specific historical terms like the jizya, zakat, or the fiscus judaicus.
Okay, you've got to break those down for us. What was the jizya?
The jizya was a per capita tax, a head tax, that was levied on non-Muslim subjects who were permanently residing in Muslim lands under Islamic law. It was a form of assessment based on your status and in exchange for protection from the state. It wasn't about your house, it was about your person and your religion.
And zakat is different.
Very different. Zakat is one of the 5 pillars of Islam. It's a form of obligatory almsgiving that's treated as a religious duty or a tax. It's often assessed on a person's accumulated wealth above a certain minimum. The funds are then used to help the poor and needy.
So the idea of looking at someone's standing in society or their total wealth and assessing a contribution based on that, it's ancient.
It is absolutely fundamental to any form of organized human society. It doesn't matter if it's a secular government paving roads or a religious community supporting its poor. The mechanism is the same. You have to have a system for the assessment of capacity to pay. You cannot build a civilization without a way to pool resources, and you can't pool resources without first assessing who has what.
The source also mentioned a specific school of thought called Georgist taxes, or land value taxation. This felt like a really specific philosophical argument embedded in the material that challenges the way we do things right now.
Oh, this is a huge and, perennially debated topic in economic circles. Henry George was a 19th century American political economist. His central idea was that people should be able to own the value they produce themselves, like the house they build or the business they run.
Okay, that makes sense.
But that the economic value that is derived purely from land, its location, the natural resources under it, the value created by the surrounding community, that value should belong equally to all members of society.
So if I'm understanding this right, the idea is to tax the land itself, but not the building that's on it.
Exactly. That's the core of it. Think about our current system for a minute. If you buy a rundown, vacant lot in a city and you invest your money to build a beautiful, productive apartment complex on it, what happens to your assessment?
It goes way up. My taxes go way up.
Right. The system, as it's currently designed, effectively punishes you for improving the neighborhood. It incentivizes you to leave that lot vacant or dilapidated to keep your taxes low. This is what creates slumlords, or those weird empty lots you see in prime downtown areas.
That makes perfect sense. I improve my property, I make the neighborhood better, and the assessor comes and punishes me with a higher bill.
The Georgist argument is, let's flip that entirely. Let's assess the land at its highest and best potential value, regardless of what's currently on it. So if you own a prime corner lot in downtown Manhattan, you should pay a massive tax on the value of that land, whether you have a skyscraper there or a gravel parking lot.
So it forces you to build something useful. It forces development.
It forces the efficient use of land. It encourages development and discourages speculation. It's a completely different way of thinking about assessment, not just as a tool to collect cash, but as a tool to actively shape the physical form of a city.
It's just amazing how much philosophy is hidden inside these boring-sounding numbers. We think it's just math, but it's actually a series of decisions about what we, as a society, choose to value and what we choose to punish.
It really is. It's moral philosophy disguised as arithmetic.
But of course, wherever you have rules and numbers, you have people who are trying to break them, or at least, bend them until they snap. And this brings us to the section of the source material that read more like a spy novel than an economics paper. The dark side of assessment.
Avoidance and evasion.
The source draws a pretty sharp line between those two terms. What's the fundamental difference?
It is a critical legal line, though it's often a very thin moral one for many people. Tax avoidance is legal. It is using the existing rules of the system, as written, to minimize your tax bill.
Give me an example of that.
Taking a deduction for your mortgage interest is tax avoidance. Putting money into a 401k to defer taxes is tax avoidance. It's legal tax planning.
Okay. And tax evasion?
Evasion is illegal. It is fraud. It is actively lying. It is hiding assets you're supposed to report, underreporting your income, or just flat out refusing to pay what the law says you owe.
The source calls it a cat and mouse game. And the names of the avoidance strategies, they sound like cocktails at some kind of spy bar in Geneva.
They really do. They have a certain flair.
We have the double Irish, the Dutch sandwich, the single malt.
And they are all these fascinatingly complex and often perfectly legal structures designed to do one thing.
Explain the Dutch sandwich. I'm getting hungry just saying the name, but I have a strong feeling it's not about food.
No, it's not. It's about moving money around the globe to avoid assessment. These strategies are all related to a concept that tax authorities call BEPS. That's BEPS. It stands for base erosion and profit shifting.
BEPS? That sounds like a disease.
For national treasuries, it is a disease. The basic idea is that large multinational companies operate in many, many countries, and they want their profits to be assessed for taxes in the country that has the lowest possible tax rate.
Right. So if I'm a tech company and I make $1 billion selling phones in France where the corporate taxes are high, I want to find a way to pretend I actually made that money in.
A tax haven, or what's called an offshore financial center, a place like Bermuda or the Cayman Islands, where the corporate tax rate might be close to zero.
But how do you actually move the money? If I sell the phone in Paris, the cash is in Paris. You can't just wire it to Bermuda and say it's not French profit anymore, can you?
Not directly. That's where the Dutch sandwich and these other schemes come in. They often rely on something intangible, intellectual property, IP.
So patents, logos, algorithms, that kind of thing.
Things that have immense value but no physical location. So the value isn't the physical phone you sold in Paris. The argument goes, the real value is the patent on the phone or the software running it.
I think I see where this is going.
So Company A, the French subsidiary, pays a huge royalty fee to Company B, which is a shell company located in, say, the Netherlands, for the right to use the company's logo and patents.
And that royalty payment is a business expense in France, so it reduces their taxable profit there.
Exactly. It moves the profit out of high-tax France and into the lower-tax Netherlands. Then, through a series of other shell companies involving maybe an Irish subsidiary, that's the sandwich, the money finally gets moved to a zero-tax haven like Bermuda.
So at the end of the day, the $1 billion in profit is never assessed in France, where it was earned, and it's barely assessed in the Netherlands. It lands in a place where the assessment is zero.
Effectively, yes. They are gaming the system to choose where their value is assessed. It's the ultimate form of assessment shopping.
That is incredibly clever and also incredibly frustrating for the countries like France that are losing out on all that revenue.
It is the ultimate manipulation of the concept of assessment. And notice the fundamental difference here. You, as a homeowner, cannot move your house.
Right. My house is stuck in the ground. It's physically here.
The lister can come to your door and count your spoons. The assessor can come measure your front porch. You are, for tax purposes, a sitting duck. Your assets are immobile and easy to assess.
But capital isn't.
But capital, intellectual property, corporate profits, those things are fluid. They are electrons. They can fly around the world at the speed of light to find the jurisdiction with the lowest assessment and the lowest tax rate.
That is such a powerful and infuriating image. The immobile house versus the hypermobile capital. It feels completely unfair.
It highlights a massive structural disparity in the global tax system. The burden of assessment, and therefore taxation, falls most heavily on the things that cannot move, which are labor and real estate, while the things that can move often find ways to escape assessment entirely.
And the source mentions the specific places that facilitate this whole system. Tax havens, corporate havens, Ireland, Panama, Switzerland are all named.
Right. These are the jurisdictions that have built their economies, in part on offering these low-tax or no-tax environments to attract that mobile capital.
And the source also mentions the moments where this whole shadowy system was kind of cracked open, the Paradise Papers, the Panama Papers, and the Luxembourg leaks. These were massive data leaks from law firms and banks, right?
Massive. Leaks of millions of documents.
Oh.
And they exposed in excruciating detail how the world's wealthiest individuals and largest corporations were using these incredibly complex assessment loopholes and offshore structures to hide what turned out to be trillions of dollars in wealth.
Trillions.
It showed that while your local assessor is meticulously measuring your back porch to see if it adds $500 to your property value, billions and billions are slipping through the cracks at the global level because the value is being intentionally hidden inside anonymous shell companies.
It really does put that lister in Vermont into a much broader and kind of sadder perspective.
It does. It just shows you the scale of the game. It's played at the local level and the global level, but with very different rules for different players.
But this leads perfectly into the final section of our deep dive, because this isn't just something that's happening in the dark anymore. People are studying this. There are, detectives on the case.
The research and advocacy world.
Yes.
The source lists some real heavy hitters in academia who have dedicated their careers to this. People like Gabriel Zucman, Mihiradi Desai, and Joel Slemrod.
Let's talk about Gabriel Zucman for a second. I feel like I've seen his name popping up in headlines a lot recently.
Gabriel Zucman has effectively become the world's leading detective of hidden wealth. His research is groundbreaking because he's trying to assess all the money that isn't being assessed. He uses these very clever methods looking at anomalies in global financial data to estimate exactly how much wealth is being hidden in tax havens.
So he's essentially trying to do the job of a global tax assessor where one doesn't actually exist.
That is a fantastic way to put it. He's trying to create the grand list for the entire global economy, trying to find all the missing spoons, so to speak.
And then alongside the academics, you have the advocacy groups. And it's really interesting to see the different angles they take on the same problem. The source lists groups like the Tax Justice Network or TJN and Oxfam.
These groups often come at it from a fair share perspective. Their argument is that the current systems of assessment are fundamentally broken and unjust because they allow all that fluid capital to escape, which leaves a heavier burden on regular working people and small businesses. They advocate for closing the loopholes, like the Dutch sandwich.
And on the other side of the spectrum,
Well, it's not always a clear other side, but you have groups like the Tax Foundation. They tend to focus more on tax policy analysis from an economic efficiency standpoint. So they might look at that Dutch sandwich and say, well, the reason companies go through all this trouble is because corporate tax rates are too high and too complex in the first place. If we simplified the tax code to lower the rates, we'd create a more competitive environment and they wouldn't need to hide the money.
so different diagnoses and different prescriptions for the exact same problem.
Exactly. One side says the rules are too weak, the other says the rules are too burdensome.
And just to wrap up the sheer scope of this topic, the source has this massive, almost absurd list of countries at the end. It literally goes from Albania to Zimbabwe.
It's a great reminder that while the specific jargon changes, maybe you don't have a lister in Zimbabwe or a mill rate in Albania, the fundamental challenge is completely universal. Every single society needs resources. And every society needs a system to decide who contributes and how much.
It really is a global human experience. We all live under the clipboard in one way or another.
We absolutely do.
So let's try and bring this deep dive in for a landing. We have covered a lot of ground here. We started with a local official, measuring a basement in a suburb somewhere. And we ended with these complex, global, profit-shifting schemes that involve patents and anonymous shell companies.
It's a pretty big journey for a topic that just starts with a single, boring-looking bill in the mail.
It really is. So if we had to synthesize all of this, what is the single biggest takeaway? Why does understanding this word assessment actually matter to the average person?
For me, the key takeaway is that assessment is the bridge. It is the crucial and often invisible bridge between the world of private wealth and the world of public function.
The bridge, I like that.
It's the mechanism that turns value, which is, an abstract, floaty concept, into revenue, which is concrete action. It's the process that turns the market value of your house into a school teacher's salary. It turns a corporate transaction into a newly paved road.
It's the translation layer of society's operating system.
Yes, that's a great way to put it. And it's a layer that we ignore at our own peril. Because if we don't understand how that value is calculated, we can never really understand how our society is funded or who is truly paying for it.
That leads perfectly into our final provocative thought. We always like to leave the listener with something to chew on, something that might make them look at that boring envelope a little bit differently next year.
Here's what I want you to think about. We've established throughout this whole conversation that assessment is, at its very core, an opinion. It is an estimate. It doesn't matter if it's the lister in Vermont looking at your barn, or a massive computer algorithm valuing a corporate merger, or a government geologist estimating the value of a mineral deposit in the ground.
It's all subjective at some level.
It is inherently subjective. So my question is this. If assessment is really just an estimate of value, an opinion that we've all agreed to treat as fact, how much of our global economy is actually based on these subjective decisions made by people with clipboards? We treat these numbers as hard facts. My house is worth X. This company's worth Y. But they are just assessments. They are, in a sense, administrative fictions that we all agree to believe in to make the system work. And with that in mind, when was the last time you actually checked the math on your own bill?
Because if you aren't checking the assessment,
you are letting someone else's opinion dictate what your slice of the world is worth. And there's a pretty good chance they might be wrong.
That is both a terrifying and a very empowering thought. Check the math, folks.
Always check the math.
Thanks for diving in with us. We'll see you next time.